Hello class, in this video I'd like to cover the first several assignments for Chapter 10, so let's get started. Let's cover a brief exercise 10-4, and on this one in the book, it's on page 489, it says that this company issued 1,000 shares of $1 par value common stock and it received $30 per share. So to record this entry, we see that the cash being received is 1,000 shares times 30 per share, or $30,000. And what we then have is a credit to common stock, but you look at this and you see we only record the par value in the common stock account as a credit. So this will be 1,000 shares times the $1 par value per share, and that's the credit to common stock. The rest of the amount we receive above par value is recorded into the additional paid-in capital account. So there's the first entry. The second entry, they say, how would this entry differ if Gothic issued no par stock? If this stock did not have a par value, then the cash entry would be the same, but the common stock entry would be all $30,000 is entered into the common stock account as a credit. There's no par value to deal with, so there's no other additional paid-in capital account that we have to make an entry for. So that's number 4. The next one, brief exercise 5, right here. On this one we have 1,000 shares being issued, 1 penny per par value common stock, per share par value, and they sell it at $32 per share. Here we have an extreme example of the amount the price, the stock is being sold for compared to the par value. So if 1,000 shares are sold and we receive $32 a share, $32,000 is recorded in the cash account. Preferred stock, only a penny per share times 1,000, only $10 goes into the preferred stock account. This is preferred stock here, not common stock. The difference, just subtract, and so we have a large amount going into the additional paid-in capital account, the $31,990. So even though you might have a par value that's very low, record the cash coming in, only record the par value in that stock account, whether it's preferred stock or common stock, and then the difference goes into the additional paid-in capital account. And number 7, we have 2,000 shares of 7% $50 par value cumulative preferred stock being issued, and that was issued in 2016 at the beginning of the year, and the rest of the stock is common stock. Now the company did not pay any dividends in 2016 and 2017. Then they decided to pay $23,000 in dividends in total in 2018. So we have to decide how much of the $23,000 in total dividends goes to the preferred stockholders and then how much goes to the common stockholders. The first thing we do is find the preferred dividend annual requirement. That'll be the par value per share preferred stock times that percent given to us, 7%, times the 2,000 shares. So each year the corporation is, quote, supposed to pay $7,000 in dividends. If it doesn't, since this is cumulative preferred stock, then we have to catch up with the missed dividends when dividends are finally paid in later years. So if we have $23,000 total in dividends for 2018, we first catch up for 2 years of missed dividends, 2016 and 2017, so 2 years, $14,000. Then we pay to the preferred stockholders the current year's dividends, 2018, for 1 year. And then the rest of it, $2,000, goes to the common stockholders. So the $2,000 is found by taking the total of 23 minus these two numbers that you allocate to the preferred stockholders. So 23,000 minus the 14 minus the 7 equals 2,000. The next one is number 8. In this one, the corporation sells some $1 par value common stock, sells at $35 per share. Later in the year, the company buys back, repurchases 100 of those shares, and has to pay $38 per share. The entry for this. For treasury stock entries, the first thing to remember is ignore par value. We don't use it in the treasury stock entries. So whatever we pay for the treasury stock, we record that into this new account called treasury stock, and our cost, 100 shares, $38 per share, $3,800, and of course we paid cash for that, so that's the credit. So debit treasury stock and credit cash for the amount that you paid for the treasury stock. The next one is number 10. And on this one, we have 4,000 shares of common stock outstanding. On October 1st, which is the declaration date, the company declares a 75-cent per share dividend to the stockholders of record on October 15th. So October 15th is the date of record. The first entry, October 1st, the date of declaration, we take the 4,000 shares outstanding times the 75 cents dividend per share, and so the debit to the dividends account is $3,000. Dividends payable then is credited. It's a legal liability for $3,000. So debit dividends and credit dividends payable, $3,000. Now the October 15th entry, there's no entry. This is just a paperwork to decide, who owns it at the end of this day. And then October 31st is when we pay the dividends. We drop the dividend checks in the mail. The entry here would be to bring this up a little bit, would be to, too much. To debit dividends payable, remove the liability, and then credit cash for the $3,000. So for declaring and paying the dividends, we have entries. Declaration date, payment date, but no entry on the date of record. So that's it, and I will see you in class.